the negative growth rate will continue, if not accelerate to the downside during the next 3 to 6 months. This is a very unusual period. In fact, in my career, I've never seen it go negative, and I've been in the business for nearly 45 years. So this is uncharted territory. And in fact, the last time we saw meaningful declines in the money supply was in the Great Depression, which was, of course, a very deflationary period. So it's very interesting to hear the Larry Summers of the world hearkening back to the 70s in terms of expectations for inflation. He's ignoring a lot of real-time indicators, a lot of market indicators, and we'll spend a lot of time on that in a minute. Now, when I say uncharted territory, if you look at the average money supply growth for the last 25 years and the last 50 years, a very long time, the average money growth has been 7% at a compound annual rate. So, zero negative is a huge departure, and we believe highly deflationary, and we're beginning to see that as I will illustrate as we get into the market indicators. The Fed funds rate went to 4.5% in December, and it does appear that the Fed is determined to take it up again. They want nothing to do with a legacy associated with inflation. And as we've suspected for some time, they are unanimous because there are people like Larry Summers out there saying, you're going to be responsible for another run at 70s style inflation, which was highly destructive. And many times I've mentioned here that the 70s inflation is nothing like the inflation we just experienced. The 70s inflation started in the mid-60s with the Vietnam War, with the Great Society programs, one after another, and then we went off the gold exchange standard and lost all discipline. That's nothing like what we've been through. We have been through a massive supply shock, two of them, COVID-related, and then the Russia invasion of Ukraine. Very different circumstance. One led to lasting inflation, and this one, we believe, as I've mentioned many times before, will be much like what we saw in the early 1920s after a pandemic and World War I. Inflation collapsed. It actually ended up at negative 15% in June of 1921. And we do believe this year we're going to drop below 2%. And in fact, the bond market believes it. The bond market's break-even rate is 2% for the next 10 years. In other words, the bond market is expecting 2% inflation for 10 years. And this is the Fed's goal. The bond market thinks we are already there. And in fact, we believe the bond market will continue to rally, meaning long-term interest rates coming down relative to short-term interest rates, inverting the yield curve. Right now we're at 70 basis points, a little more than that. And it is interesting now to watch the bond market disengage somewhat from the Fed's rhetoric. And the stock market has not done that yet. In fact, the stock market is behaving like the Fed is right. The energy sector is reaching for all-time highs, even though oil prices peaked in 2008, and we believe are in secular decline. And we'll get into that in a moment. On February 1st, we'll probably see another 25 or 50 basis points, so we will be at 4.75 or 5%. Now, most of the Fed governors are saying roughly 5%, maybe a little bit more, and then we're done. Maybe the Fed will start talking a little bit more about some of the very significant declines in inflation and outright prices that we have begun to see. And again, we'll go into that in a moment. One other thing to note about monetary policy, it's very influenced these days by Keynesian economics and something called the Phillips curve. And Phillips curve basically suggests that if employment is strong, then that will lead to inflation. The history of the last 40 years, however, is the opposite. Employment was pretty strong when you adjust out for recessions, pretty strong for the last 40 years. And yet inflation and interest rates came down quite a bit from mid-teens in the early 80s to 0.5% during COVID. So the history of the last 40 years does not support the Phillips curve. And yet it is interesting to listen to the Fed say, oh, wow, employment, we got to get it down. Otherwise wages are just going to take off and become embedded in the system. That was the 70s experience, but it has not been the experience since then. And we do not believe we're in anything like that environment, as I just mentioned. And now the reason it's wrong is when employment is increasing, employment and output are increasing. If they're increasing in a healthy way, then productivity is increasing as well. And we've had a lot of dislocations associated with supply chains recently, so it's very hard to tell where we're going to settle out in terms of productivity. But we do believe, if we're right on how much innovation is taking place, that productivity is going to start scaling in a surprising way and take the sting out of inflation fears completely. If you owned energy, which was up 59% last year in the equity market, you did very well. And as you know, we don't own energy. In fact, we're very negative on energy, certainly from a secular point of view. And now I would submit a cyclical point of view. Prices peaked in March at 130. They're down to 74, West Texas Intermediate. And yet the sector indices and for energy sector index is reaching for its all-time highs. And if I look at this chart and from a long-term point of view, what I am seeing is a triple top in 2008, in I think it was 2015, and now in 22. I'd be very surprised if it gets to a new high because the fundamentals are deteriorating. Demand destruction is real. China, some of the numbers that have been coming out of China are astoundingly weak. And of course, zero COVID is a reason for that. But I do believe China's been building inventories. And the reason it has been doing so is it's using the Russian war. It is buying oil from Russia at significant discounts. And we don't know how long this window will be open. The discounts reports are in the 30 to 40% range. So we would not be surprised to see inventories much higher almost everywhere in the world because of the war in Ukraine and the fears about not getting energy supplies, and China and India buying disproportionate amounts of oil from Russia. Russia doesn't have very many other places of size to sell that oil.